Hi guys, welcome back to MURO HQ. We're here today joined by Canio and Michele from Michele Romano Accountants. Today we're going to be talking about the federal budget. We know that happened on Tuesday night. Josh Frydenberg put all these details out there. There was a rebuttal speeches that came through from the opposition, and today, Friday, we're bringing you live the information that we have to hand. We do know that some of those bills have potentially been passed, so watch your space. We'll have a bit more information once they pass by. But let's cut to the chase. So I wanted to talk to Canio today about a few things that have come out of the federal budget. First things first, personal tax cuts. Obviously we're accountants, we're dealing with tax. Personal tax cuts to our clients mean a lot. So do you want to run us through, Canio, what the personal tax cuts have done, where they've changed and where they're going?
Yeah, absolutely. What a spendathon that we just witnessed Tuesday night. But personal tax cuts were legislated to come in a couple of years' time. So what I'll basically phrase about that is that this isn't anything new. These things were going to come out in a couple of years' time, and because of the COVID, we brought it forward. But the good thing about it is we've got the different tiers of tax. The two main bands that got attacked was the 19% marginal rate. So the limit of that now is $45,000. It was $37,000. And the next band was the 32.5% bracket that went from $90,000 to $120,000.
Okay, cool. So most of our clients will obviously benefit from that.
Yeah, absolutely. And this is going to be backdated the 1st of July, provided it gets royal assent. And that means what I think will happen to do is that once that comes through, the ATO will get some guidelines from the Treasury, and they'll probably backdate the cuts, and so therefore in your next pay packet, you'll be pro rata for the rest of your pay for the year. So yeah, every single person that are in those bands will get a bit of an extra couple of bucks in their pocket.
Yeah, good. Okay, so I think they're the questions that have come out through the piece. So that's cool. Question in the superannuation space. So has there been anything in super that is worth talking about?
Not so much. I think the opposition, the Labor Party, pushing the fact that they're not happy with people taking money at super. So just quickly, and it's not really the theme of this budget, but they have discussed superannuation. So our clients out there who do have SMSFs, or all of our clients who have super, they're making the super funds more accountable. So when you move employers now, you will have your prior superannuation fund that you have basically stapled to your account, so that they have to or are obliged to use the same one rather than opening up a raft of different ones. There's also more accountability now on super funds that are underperforming. There'll be a register now for underperforming super funds, so you can actually have a look at yours, and if it's not been doing well, you might decide not to stay there anymore. And there's also some carve-outs, which means that if you, as a super fund, aren't hitting benchmark targets, you're not going to be able to put any more members on. The last one that is important for our clients that are in super, our trustees and SMSFs, there's more accountability coming. So a lot of you are in our SMSF care programs, so we'll have more information on that coming through. But just be aware, nothing really major, but still something to think about.
Okay, cool. And we've had a lot about JobSeeker, JobKeeper. Now we've got this new JobMaker. Again, I don't know if there's really a lot there that we need to worry about at this stage, but there obviously are some clients that have got problems in this space.
Yeah, now I'm not a massive fan of this provision, and I mean part of this discussion to tell you about it, and we've sent out information, but also give you a bit of a spin on it. I think that it's between $100 and $200 a week for certain people who are on government support in a lead up to getting a job. So people will get subsidised. Employers will get subsidised either $100 or $200 for the employee who they've taken off government support, depending on their age. Now, I think this is a bit of a drama because of the fact that it's going to give you some industrial relations issue where now potentially you're favouring people under 35 for that job, or people under 20 or something to
what was
that job.
The age range was 16 to 35, wasn't
yeah,
it?
so it's basically from that, but there's two different tiers. So you need to be able to be in those tiers to get the $200 or the $100. But then again, I just think that's not good business. I think that you should be employing people for merit, regardless of what you're going to get from the government. So, $100 a week, okay, yeah, it's money and it's going to help you, but if that person is not the right person for the job, it could cost your business heaps more than that.
Okay, cool. I think the other question we're getting a lot of, probably in the last couple of days, is the whole deductibility around capital assets. Obviously, the government brought out that $150,000 write-off, asset write-off. What we've seen now come through the budget is some exciting stuff, I think, probably for a lot of people that are thinking going to the next level. So what's happened in that space there?
Yeah, the fine print is that the government wants you to spend money. It wants businesses to go out there and buy machinery and boost the manufacturing industry. We all saw that during COVID. We've got a shortage and everything. I went down a bike shop the other day and there's not enough bikes coming to the country because of COVID and people not working and so forth. So they want us to be a manufacturing hub. Typically people who buy a lot of paint are manufacturers, but not only are manufacturers, all my hospitality clients, coffee machines and stuff. But let's be realistic about this. It's a spendathon. So what happens is you buy pretty much anything in your business that's a plant equipment. So no, it's not your car. So normal cars get what's called a luxury car limit of about $57,000, but trucks, heavy road haulage equipment, trailers, coffee plant, a manufacturing plant, cutting machine, all that sort of stuff, right? There was a limit recently that was about $150,000 depending on your turnover. They basically said under 5 billion, which, is going to be most of our clients, if not all, you can basically spend whatever you want on that equipment and get a full-on write-off this financial year or the year that you spend the money on. This provision goes up to 2022. But before that, as you rightly, I think, mentioned before, Michele, it's $150,000 before. So really, it's only going to help those clients or those businesses who wanted to spend a bit more on a single asset. Because remember, the 150 was any type of assets. You could buy one for 150, another one for 150, and you'd still get the whole $300,000 provided the two different identifiable things. So I think there's a little bit of politics in play here. I think that it's a really cool thing and it's getting people confident. But realistically, I think 9 out of 10 clients, it's not going to affect them because they'd be under that 150 threshold anyway.
Yep.
Secondly, as accountants, depreciation is depreciation. So you'd actually be able to claim that deduction over the useful life of the asset anyway. So you're just getting a big shocker hit today.
Yep. I think so. So they talked about bringing the extension to December, right? So December 2020 was that 150 was going to basically be phased out. So what we're talking about now is that from the clarification is the date from 1st of July.
No, it's from the budget night. So from Tuesday night, provided it gets rolled out until as long as it's ready and installed. So you just can't put a deposit on something and expect it for the next 5 years. It's got to be ready and installed by 30 June 2022, and you get the deduction.
Okay, so remember that to 2022 we've got...
One last thing, Michele, on that, sorry. If you're under 500, is it $50 million, you can actually claim on second hand. So we get a lot of those questions as well. So it's got to be new, but if you're under the that threshold, you can actually get some.
So $50 million turnover, right?
Yes.
Yeah.
Is you can use second hand items as well.
Awesome. Okay. Well. Okay. The final thing I want to touch on probably is one of the biggest topics that is going around. It's all pertaining around the carryback, tax losses situation. So there's a little bit of intricacies in and out of this, how it all works, and I think we don't still have the full details of it. But do you want to take us through what you know and where it's at the moment?
Yeah, I think this is an accountant's dream. I think this is the one that I really believe is going to be very popular. It's probably very hard to understand now and work out what actually happens. But what this does, it actually gives you money in your pocket today. Now, a lot of businesses are suffering and losing money. So the fact that we're going to get a massive tax deduction for some equipment or whatever, or a loss that we can carry forward down the track if we make some money, doesn't really do a lot for you because you don't know if you're going to be here next year. You don't know if there's going to be third, second wave, fifth wave, or another virus, God forbid, coming in. So people are going, yeah, that's great, but I still don't believe I'm making enough money. So they're still putting off decisions. This provision will put people making decisions, because what happens is that if you have been paying tax in your company in the past and you make a loss this year, this financial year, the 21 financial year, because of buying an asset or because of COVID, you can actually go back to 2019, all the way back there, and actually go, I paid some tax that year, I'm going to claim that tax as a refund according to my loss. There's some ins and outs and some things you need to look at a bit more specifically, but in essence it's like, I can make a loss this year and I can actually go back in time where I actually spent money and get a refund of that on my current year tax return. So that means money in your pocket as early as July 2021.
And it must point out that it's only applicable to companies, right?
That's right. So it's important that people understand that it's only company rebates. Trusts and sole traders don't get that at all. So it's those companies. But I think if you look at the provisions with the accelerated depreciation, instant write-off, if you want to call that, and this loss carried back, those two combined as one is a very sound and popular, will be a very popular provision that we're putting in.
Okay, great. Well, thanks for your time, Canio. Thanks for being on the show today and talking us through the budget changes. Again, to all our clientele, if you need anything, please reach out. Our team's always ready to help you. Again, subscribe to our channels, and we look forward to seeing you next time. Thank you.